Welcome to StockTok's deep dive into DoorDash. DoorDash is the dominant on-demand food and grocery delivery platform in the United States, connecting consumers, merchants, and independent couriers at scale. At the time of recording, shares are priced at 183.89, sitting in the lower half of their 52-week range, which spans from 143.3 on the downside to 285.5 on the upside. The 50-day moving average, a short-term trend indicator, sits at 166.97, while the 200-day moving average, which reflects the longer-term trend, sits considerably higher at 220.25. The RSI, the Relative Strength Index, a momentum gauge running from 0 to 100, reads 66.9, which we characterize as neutral, not yet in overbought territory. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. DoorDash generates revenue primarily through commissions charged to restaurants and merchants, delivery fees paid by consumers, and a growing subscription product called Dash Pass. The competitive moat rests on network density. The more dashers and merchants on the platform, the better the unit economics and the harder it becomes for a competitor to displace them. The StockTok score for DoorDash is 66 out of 100, signaling a buy. Growth scores a perfect 20 out of 20. Financial health scores 18 out of 20. Profitability and valuation each score 10 out of 20. Smart money registers 8 out of 20. The picture is of a high-growth business whose valuation and profitability still demand scrutiny. Now, valuation. The question every investor has to answer: are you paying the right price? The trailing price-to-earnings ratio for DoorDash sits at 86.74 times. That is a rich multiple by almost any historical standard. The forward price-to-earnings ratio, which reflects what the market is paying for next year's expected earnings, is 69.44 times, still elevated. The EV to EBITDA ratio, enterprise value divided by earnings before interest, taxes, depreciation and amortization, a capital structure neutral profitability measure, comes in at 51.43 times, again stretched relative to broader market averages. The price-to-sales ratio is 5.91 times. Guru Focus Value, an independent intrinsic value estimate, pegs DoorDash at 201.63 at the time of recording, implying a margin of safety, the discount to intrinsic value, of approximately 8.8%. That is a narrow but genuine discount. In terms of competitive moat, in our view, DoorDash benefits from strong network effects and high merchant switching costs, which are meaningful structural advantages. Wall Street analysts at the time of recording have a consensus mean target of 252 across 42 analysts, with the high end reaching 340. The next earnings report is due May 6 of 2026, with the street expecting earnings per share of approximately 1.07, with estimates ranging from 0.83 to 1.24, a near-term catalyst worth monitoring. Market sentiment around DoorDash, as of the creation of this video, leans neutral, with insufficient recent news flow to tilt the signal in either direction. The valuation is clearly not cheap, but the data suggests you are paying for a durable, high-growth franchise. Moving to financial strength, how solid is the foundation? The Piotrowski F-score for DoorDash is 7 out of 9. This is a 9-point checklist that evaluates profitability signals, leverage trends, and operating efficiency. A score of 7 or above is generally considered strong, indicating that most fundamental health indicators are pointing in the right direction. The Altman Z-score, a quantitative model designed to estimate bankruptcy probability, registers 5.70. Anything above 3 is generally considered safe, and 5.7 is comfortably in that zone. On the balance sheet, DoorDash carries a cash-to-debt ratio of 1.67, meaning the company holds $1.67 in cash for every dollar of debt, a reassuring liquidity buffer. The current ratio, current assets divided by current liabilities, a short-term solvency measure, is 1.41, which is healthy and above the conventional 1.0 threshold. The debt-to-equity ratio is 0.33, indicating that DoorDash is not materially leveraged and the equity base is not being strained by debt obligations. Interest coverage data is not available, which is worth noting, but the broader picture here is clear. In our view, the balance sheet is a genuine strength of this business. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital, which measures how effectively management deploys capital to generate returns, and it registers at 7.23% for DoorDash. That is a positive reading, but modest. We would want to see this expand materially as the business scales. The gross margin revenue minus the direct cost of delivering the service is 50.88%, which is genuinely strong. That tells us the core unit economics of the marketplace are healthy. However, as we move down the income statement, a significant amount of that gross profit is consumed by operating expenses, sales, marketing, and technology investment. The operating margin, what remains after those costs, is 5.29%. That is thin but positive, and it represents a meaningful inflection for a business that operated at losses for years. Net margin, which accounts for taxes and other items, is 6.82%. Most interesting to us in our view is the free cash flow margin of 13.31%. Free cash flow, the cash a business generates after capital expenditures, is often a cleaner signal of earning power than reported net income. A 13% free cash flow margin at this stage of DoorDash's development is a constructive signal, and one the market is beginning to price in. Onto growth. Is this business expanding, and at what rate? This is where the DoorDash thesis becomes most compelling, and why the StockTok growth score is a perfect 20 out of 20. Revenue growth over the trailing 3 years has averaged 27.7% per year. Extend that window to the trailing 5 years, and the compound annual growth rate is 25.4%. To put that in context, sustaining mid to high 20% revenue growth at the scale DoorDash now operates is an exceptional outcome. Most businesses at this size see meaningful deceleration. The marginal moderation from 27.7% to 25.4% over the longer window is worth noting, but the data suggests the business is compressing that deceleration curve more slowly than the bear case anticipated. Book value per share, a measure of the accounting net worth of the company on a per-share basis, has grown at 10.2% over the trailing 3 years. That is a more measured pace, reflecting the capital intensity of scaling a logistics and technology platform. DoorDash pays no dividend, which is entirely consistent with its growth stage profile. The capital being retained is being reinvested in platform expansion, international markets, and new verticals such as grocery and convenience delivery. The setup here, in our view, is that of a compounder still in a relatively early phase of its runway. Now let's talk smart money. What institutional capital is actually doing with this name? 20 top-tier investment managers tracked by our data sources currently hold DoorDash in their portfolios. Among the most notable, Henry Ellenbogen of Durable Capital Partners has DoorDash as 7.67% of his portfolio, a substantial conviction position, and has added to that holding by over 114%. Stephen Mandel of Lone Pine Capital initiated a new buy position. Lee Ainsley of Maverick Capital added to his position by an extraordinary magnitude, reflecting a high conviction move into the name. These are not passive index funds. These are concentrated, research-driven investors making deliberate allocation decisions, and their behavior here skews constructively toward DoorDash. However, the broader institutional picture is more nuanced. Only 6.7% of 13F filers, institutional investors who disclose holdings to regulators, are net buyers at the time of recording. A figure above 50% would indicate broad-based institutional accumulation. 6.7% suggests that institutional positioning is still selective rather than consensus. Insider ownership stands at 0.40%, a low reading, meaning management has limited direct equity exposure. Compounding that signal, insider transactions over the trailing 3 months show 0 purchases and 22 sales. We would characterize this as a flag worth monitoring. Insiders selling is not always alarming. It can reflect liquidity or diversification needs. But the volume here warrants caution, in our opinion, and is a contributing factor to the smart money score of 8 out of 20. And finally, the verdict. Let's bring it all together. On valuation, DoorDash trades at a premium multiple by conventional measures, but the Guru Focus value model suggests a narrow discount to intrinsic value at the time of recording, and Wall Street's consensus target implies meaningful upside. In our view, the valuation is elevated but not irrational for a business growing at this rate. On financial strength, the balance sheet is a clear positive. The Piotrowski and Altman scores both signal a well-capitalized, operationally sound business. On profitability, the company has achieved positive operating and net margins after years of investment phase losses, and the free cash flow margin of 13% is the most encouraging signal in the profitability stack, though return on invested capital still has room to expand. On growth, the trailing 3- and 5-year revenue growth rates in the mid to high 20s are best in class, and the growth score of 20 out of 20 reflects that this is where the bull case rests most firmly. On smart money, select high-conviction managers have added aggressively, but broad institutional buying is limited and insider selling activity is elevated. A mixed and watchful signal. The overall StockTok score of 66 out of 100 frames DoorDash as a quality growth compounder trading near fair value, with meaningful upside if the margin expansion thesis plays out. One might argue the case for a long-term position here, but we would want to see return on invested capital expand and insider selling moderate before adding size. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on DoorDash. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.